There are two types of rates on reverse mortgage. You have a fixed rate and you have an adjustable rate. So with a fixed rate, it's just like with a traditional 30-year fixed rate mortgage. The rate will never change. You might see that as a pro, you might see that as a con. So if you lock in your fixed rate at a low rate, that's great. It'll never change and you have that for the rest of your mortgage. And with an adjustable rate, the rate will adjust at a certain frequency, and we'll talk about that. Now, adjustable rates come with what's called caps. And caps exist to protect you from significant changes in the interest rate. So you have two types of caps. You have a lifetime cap and you have a monthly cap. A lifetime cap means that the interest rate will never go above a certain number for the remainder of the life of the loan. So usually that's either 5 or 10%. And it's important to note when we're talking about lifetime caps, we're about 5 or 10% above the initial rate on a loan, not 5 or 10% as the total rate. Meaning that if you have a 10% cap on your lifetime cap and you start your loan at 5%, it is a 15% actual cap, right? The rate can't go above 15%. So just make sure you keep that in mind. You also have a monthly cap. That's just a cap on how much it can change month to month. So that is usually 1 or 2%. Again, these can vary depending on market conditions, depending on your lender, depending on your product, etc. Now, let's talk about why you might want an adjustable rate or a fixed rate. Now, with a fixed rate, you are not eligible to get additional proceeds after the loan closes. That means that you are only able to get the cash out that you collect at closing. That means that you cannot get a monthly payment, and that includes the term payment or the 10-year payment. The term payment is a monthly payment set for a couple of years or months or however you decide to structure it. The 10-year payment is a payment for the rest of your life. That is not possible under the fixed rate product. You also cannot have a line of credit. And the line of credit, just as a reminder, is a product or a product feature that makes it so that you can request funds at your wish from your mortgage servicer. So you could mail in a form, request $10,000, and they'd send you a check for that amount. That's not possible in the fixed rate. With the adjustable rate, all these other payment options become available. So these support all payment options. So that means you could get a line of credit, you could get a monthly payment, lump sum, or any combination of them. You could say, I'd like a monthly payment for the rest of my life. I'd like to put some money in a line of credit to draw for emergencies, and I'd like to get some money to get as cash out today. You have the ability to access all of that. One other item to note with the fixed loan is that in some cases, and you'll want to talk to a mortgage advisor or to a licensed mortgage lender when you talk about this, you may be leaving cash on the table due to the initial disbursement limit. We talk about this a little bit more in depth in the book, but in some cases, fixed rate mortgages actually cap you at only 60% of proceeds. Basically, that means that you might be leaving money on the table with a fixed rate mortgage. Again, it depends specifically on how you decide to structure your reverse mortgage. So there's some caveats there, but we definitely want to make sure that we're not in that camp. Now, with all of this being said, now kind of understanding the differences between the adjustable and fixed rate, the adjustable rate is by far the more common product option. I believe that over 90% of reverse mortgages originated are the adjustable rate. And it makes sense. There's a lot of really good product benefits that are available to the adjustable rate that just have not been carried over, that don't exist on the fixed rate. Going a little bit deeper now on the adjustable rate, let's talk about how that rate is determined. So when you get an adjustable rate, you'll see your interest rate, and that is equal to two things. It's the index and the margin. The index, that is going to be a floating economic indicator, and that's a fancy way to say it's going to be a number that changes day by day and month over month. The index is usually going to be the 10-year CMT, which is a constant maturity treasury, or the 1-year CMT. These are the most commonly cited indices. So if you go open up the newspaper, go look at the Wall Street Journal, they're usually reporting what's going on with the 10-year CMT or the 1-year CMT. These are known as the treasury bonds or the treasury yields. So you can look at those. Right now, they are trading around 4.25% today and around 3.75. Now, these will change, so they can always be different. So if you look at this video in a couple of years from now, we're recording in spring of 2025, the rates could be higher, they could be lower. It just depends. Now, the other number that gets added to the index is the margin. Now, when we say margin, I always like to call it the profit margin because it is the number that gets added to the index. So when you're looking at a reverse mortgage, you want to look for a margin. This number is usually between 1.5% to 3%. And the margin will vary depending on various factors. But understand that as a borrower, you want to look for a lower margin. So lower is better here. And that should make sense, right? Because we want to pay a lower interest rate. So if we have a index, and we can't control that, right? So if we have an index that's 4.25% and a margin that's 1.5%, what are you going to pay? You're going to pay 5.75%, right? Just the sum of these two numbers. That's your interest rate. However, if you have a higher margin, right, 4.25, let's say that it's a 3% margin, you're going to pay, let's see, 7.25% as your fully indexed rate. So as a borrower, it's going to be in your best interest to get a lower margin. Now, if you're in a reverse mortgage currently and you're looking at your mortgage statement and you're saying, oh my God, my margin is really high. I have a 4%, 3.5% margin. That's okay. You can reach out to us and we can look at possibly refinancing. In many cases, we can actually help people reduce the margin on their loan and obtain access to additional proceeds. So that wraps up our conversation today about reverse mortgage interest rates. If you like this kind of content, make sure that you subscribe. Check out our book here, The Retirement Solution. You can get a free PDF of the book using the link in the description as well. So make sure to check it out and let us know if this is helpful. If you have any other questions about reverse mortgages, we are here. You can email us at info@southrivermtg.com. Again, that is info@southrivermtg.com. Or you could give us a call here. Look forward to speaking with you. Hope this content was helpful, and let us know if you have any questions. Thanks.